What causes the market wage to change? How do economists explain the equilibrium wage? Well, if you think about it, the wage is just the price of labor. And we certainly know how to explain prices. They're set by the interaction of supply and demand. So to understand the wage, we need to think about tools we already have for explaining other prices. Let's look at the demand for labor, the supply for labor, and the way they interact to determine the wage at which the labor market clears. First, we'll do a quick review of the two sides of the labor market, the demand for labor, and then the supply of labor. The demand for labor is determined by the behavior of profit-maximizing firms. Let's look first at the individual firm's demand for labor, and it's simply that firm's marginal revenue product curve. That is the curve that describes the amount of revenue added by each additional worker that the firm hires. The profit-maximizing rule is that a firm will continue to hire workers as long as the marginal revenue product exceeds the wage. That is, as long as each additional worker adds more to the firm's revenue than it adds to the firm's costs. Anytime you're looking at a graph like this in economics, it pays to ask three questions. And if you can answer those three questions, then you really understand the story that's in front of you. The first question is, what is the story or the relationship that's being described in this picture? And in this picture, it's a relationship between the wage in the market and the amount of labor that an individual firm finds it profitable to hire. The second question you should ask is, what accounts for the slope of the curve? That is, in this particular case, why is the demand for labor or the marginal revenue product curve downward sloping? And the answer depends on the marginal product of labor. Remember, each additional worker that you hire eventually adds less output than the previous worker. The marginal product of labor diminishes as you hire more and more workers, and that means each additional worker adds less to the firm's output, and therefore less to the firm's revenue than the worker previously hired. You can also think about the elasticity of the demand for labor, which influences the slope of the curve. Whenever labor demand is more inelastic, then a given change in the wage has a smaller impact on the firm's labor hiring than when the demand curve for labor is more elastic. For example, when the marginal product of labor is changing very rapidly, a small change in the wage will cause a firm to make a very large change in the amount of labor that it hires. But if the demand for labor is more inelastic, then the same change in the wage results in a small change in the firm's quantity of labor demanded. The third question you want to ask about any graph in economics is, what would cause the curve to shift? So for instance, if we start with a given marginal revenue product curve describing the demand for labor by some particular firm, we want to know what would cause the firm now to want to hire more workers at every wage. That is, what would cause the marginal revenue product curve to shift to this new position, where at any given wage now, this firm wants to hire more labor? Well, remember, this curve represents the amount of revenue that each additional worker adds to the firm's revenue. So, there are two things that would cause the marginal revenue product curve to shift. The first is if the price of the good or service that this firm is selling were to increase. If the price increases, then workers producing a given amount of output are actually adding more revenue to the bottom line of the firm because the price at which this output can be sold is higher. The second thing that would cause the curve to shift is an increase in labor productivity. If either technology improves so that workers know how to make more output from a given amount of input, or if the workers get more capital to work with, or anything.
Mind Bites.